In this video, we're taking a deep dive into the SBI Magnum Hybrid Long Short Fund. We'll explore its special design as a specialized investment fund, or SIF, break down its unique collar strategy for managing risk, cover the important trade-offs you need to know, and reveal a powerful tax benefit. By the end, you'll know exactly who this fund is for and if it's right for your portfolio.
The SBI Magnum Hybrid Long Short Fund's special status as a specialized investment fund gives it a clear advantage. SEBI created this category to give fund managers more freedom than they have with regular mutual funds. And this special design gives the SBI fund some powerful tools. A typical mutual fund goes long. It buys stocks hoping their prices will go up. But this fund can do more. It can also go short. This means it can use financial instruments to profit even when a stock's price goes down. This helps the fund find opportunities even when the overall market is falling.
So how does this fund actually use its special design? The strategy is to allocate 65% to 75% of its assets into stocks and related investments, with a large part of this being protected with special tools to manage risk. Then, it allocates 25% to 35% into safe, high-quality bonds which act as a safety cushion to provide steady income. The fund can also invest up to 10% in real estate investment trusts and infrastructure investment trusts to diversify even further. But its biggest advantage is that it can simultaneously buy stocks it thinks will go up and bet against stocks it thinks will go down. It can use up to 25% of its assets for these bets against the market, which is a strategy designed to generate profits even when markets are shaky. How does the fund invest so much in stocks but still handle market ups and downs? It uses a smart risk control strategy called a collar. Here's how it works in simple terms. First, the fund owns a portfolio of good quality stocks. Next, it buys a put option. You can think of this like buying insurance. It sets a minimum price for its stocks, which protects the fund from a major market crash. To pay for this insurance, it sells a call option. This sets a limit on the highest possible profit, but it generates income to pay for the protective put option. The main goal isn't to hit huge quick profits. It's to earn a steady income from selling these options while protecting the investments from a major fall. This income, plus the interest from its bonds, is how the fund plans to provide consistent returns without taking excessive risks. By the way, if you're finding this breakdown useful, make sure you hit that subscribe button. We post deep dives like this every week to help you become a smarter investor.
This special type of fund has a few rules you should know about. First, liquidity. This is an interval fund, meaning you can only redeem your investment on specific days. For this fund, it's twice a week, on Mondays and Thursdays. You can, however, invest money on any business day. This rule helps the fund manager execute complex strategies without disruption. Second, the investment amount. The minimum investment is Rs 10 lakh. This high entry point is intentional. SEBI wants these types of funds to be used mainly by high net worth and experienced investors who understand how they operate. Third, the costs. The fund has clear fees and an exit load if you sell too early. You'll be charged 0.50% if you redeem within 15 days and 0.25% if you sell between 16 and 30 days. After 1 month, there is no exit fees. The fund's performance is benchmarked against the Nifty 50 Hybrid Composite Debt 50/50 Index. Now for an excellent feature that's easy to miss but can make a big difference to your final earnings. Taxes. Even though this fund is designed for safety, it is structured to give you the tax benefits of an equity fund. Because the fund is required to hold over 65% of its portfolio in stocks, it qualifies for equity taxation. This is a huge advantage. Any capital gains you make from holding your investment for more than 1 year are taxed at a lower rate than what you'd normally pay on a debt or bond fund. For investors in higher tax brackets, this feature alone could make the fund a smarter choice than many other safe investments simply because it means you get to keep more of your returns.
So to answer our main question, who should consider this fund for their portfolio? First, it's a good choice for the conservative investor who wants to protect their capital and earn a steady income, while still participating in the stock market's potential upside. It is especially suitable for retirees or people approaching retirement.
These investors typically need regular income and cannot afford to risk a large part of their savings in a market crash. It could also be a good choice for investors who are concerned that the stock market is overvalued. If you want to lower your risk without moving entirely to cash, this fund offers a sophisticated way to do that. Finally, it's for investors who want to add a stable, low-risk anchor to their portfolio to balance out more aggressive investments. Who should probably avoid this fund? This fund is not for a young, aggressive investor focused on maximizing profits quickly. The goal here is steady and stable growth, not huge, fast gains. So, is chasing the highest returns always the best strategy? The SBI Magnum Hybrid Long Short Fund makes a strong case that the answer might be no. By focusing on smart design rather than just high performance, it offers a compelling option for the modern investor. It leverages the new SIF framework, uses sophisticated strategies like the collar to manage risk, and provides a significant tax advantage. This fund isn't trying to be the top performer every single year. Instead, it's built to be a dependable tool that can navigate any market condition. It represents a different way of thinking about building and protecting your wealth. But now, I want to hear from you. What are your thoughts on this new breed of fund? Let me know in the comments below.